If you want to understand the end of the petrodollar, stop staring at charts and start watching ports, tankers, escrow accounts, and who gets to touch the money. Because in early January 2026, Venezuela became the loudest reminder of a brutal rule. You can change the currency on paper, but if someone else controls the corridor, the currency choice becomes decoration. Here's the thesis. Venezuela spent 2024 and 2025 trying to build a sanction-proof oil economy, selling crude outside traditional banking rails, leaning on USDT stablecoins, yuan settlement, and shadow shipping. Then, January 2026 flipped the board. If the US can seize tankers, gate the trade, and route proceeds into US-controlled accounts, Venezuela gets forced back into dollar-cleared oil flows, whether Caracas likes it or not. That's not the end of the petrodollar. That's the petrodollar showing its teeth. Tonight we'll do it in 5 moves. What people think the petrodollar is. What the petrodollar actually is, the stack. Venezuela's 2024-2025 workaround. USDT plus dark shipping. January 2026's counter move. Custody plus escrow. What it means for China, BRICS, stablecoins, and your own risk checklist. Let's begin. The myth map. What people think petrodollar means. Most people think petrodollar equals one sentence. Oil is priced in dollars, so everybody needs dollars. And that story is not totally wrong, but it's like saying a castle is a door. Pricing is the door. Clearing is the hallway. Custody is the wall, the moat, and the guard tower. The internet argues about the door because it's visible. Power sits in the hallway and the tower because they're enforceable. So if you want a strategic lens, you have to stop asking, what currency is on the invoice? And start asking, who can stop the shipment, deny the insurance, and freeze the proceeds? One more thing, because this matters. The petrodollar story people repeat also includes recycling. Oil exporters earn dollars, then recycle those dollars into US assets, bank deposits, treasuries, and dollar markets. That recycling strengthens the US financial base. But again, recycling is downstream of custody. If you can't safely sell, you can't recycle anything. The plumbing map. Pricing, clearing, custody. Here's the practical breakdown. Layer 1. Pricing, invoice. What unit does the contract use? Dollars, yuan, euros, something else. Layer 2. Clearing, settlements. How does the money actually move? Which banks touch it? What compliance filters get triggered? Does the buyer need trade finance, letters of credit, or insurance that touches systems exposed to US sanctions risk? Layer 3. Custody, physical control. Can the barrel be delivered? Can the ship be intercepted? Can the cargo be seized and redirected? Can a navy, a coast guard, or a port authority say no? If you remember only one line from this video, remember this. Layer 3 can override Layer 1. Now keep that framework, because we're going to watch Venezuela try to win Layer 2 and then watch the US answer in Layer 3. Venezuela's 2024-2025 workaround, dollar value, not dollar banks. Venezuela tried a state-backed crypto years ago, and it failed to become a stable settlement engine. So the regime's oil trade evolved into something more pragmatic. Use a dollar-pegged stablecoin to move dollar value without using dollar banks. In April 2024, Reuters reported that PDVSA was moving oil sales toward USDT, Tether, speeding that shift as sanctions returned, specifically to reduce the risk of proceeds being frozen in traditional bank accounts. Read that again. Reduce the risk of proceeds being frozen. That's not ideology. That's survival engineering. And this is where the online narrative gets confused. People call it De-Dollarization. But USDT is pegged to the dollar. So it's not escaping the dollar unit. It's escaping the dollar corridor, the regulated bank pipes that make freezing easy. Think of it like this. The dollar is the language. The banking system is the telephone network. USDT is a walkie-talkie that still speaks the language, but avoids the phone company. Now add the shipping piece. Because money doesn't matter if the oil can't move. Sanctioned oil doesn't vanish. It detours. A shadow fleet grows. Older tankers, complex ownership, flags changed, names changed, routes changed. Signals go quiet. Ship-to-ship transfers happen offshore. Cargoes get blended, relabeled, rerouted. The point is not elegance, the point is confusion. The US Treasury has repeatedly targeted Venezuelan oil networks and described how the regime depends on a shadow fleet to facilitate sanctions evasion and generate revenue. It also referenced PDVSA's designation and blocking actions under US executive orders. So by 2024-2025, Venezuela's working model looked like this. Move barrels through shadow corridors. Settle in USDT through intermediaries and wallets. Reduce the share of proceeds that can be frozen by banks. Keep export oxygen flowing. That's the crypto-petro era, and it created a dangerous headline. Venezuela is leaving the dollar. But strategically, Venezuela wasn't leaving the dollar. Venezuela was trying to leave US enforcement. And that is the difference between a slogan and a system. January 2026. The counter-move is custody. Plus escrow. Now the turning point. In early January 2026, Reuters and AP described a new US pressure campaign involving an intervention in Venezuela, a strict oil blockade, and escalated maritime enforcement. But the key detail is not who said what on TV. The key detail is who touches the oil money going forward. AP reported that the US said oil sales would continue indefinitely, and that proceeds would settle in US-controlled accounts at major banks, with disbursement at US discretion. AP also described selective removal of sanctions to enable shipping and sale, and plans to authorize imports of oil field equipment to increase production. Argus reported comments attributed to US Energy Secretary Chris Wright that the US was in talks to indefinitely take over PDV oil sales, market stored barrels, and keep selling ongoing production into the marketplace. That is not a normal sanction. That is an attempt to run the cash register. And the numbers matter because they show intent. Argus referenced claims about turning over roughly 30 to 50 million barrels from storage and then continuing sales going forward. Reuters, separately, described progress on a $2 billion deal to supply up to 50 million barrels to the US, with proceeds deposited in US Treasury supervised accounts. If those structures hold, this becomes a template. Not ban the oil, but own the auction. Now the enforcement layer. On January 7th, Reuters reported the US seizure of a Russian-flagged tanker linked to Venezuelan oil after a weeks-long pursuit. Reuters also reported the tanker had been shadowed by a Russian submarine and cited US statements that the blockade remained in full effect anywhere in the world. That detail matters because it shows escalation. This isn't just paperwork. This is a corridor contest with real players nearby. So January 2026 has three moving parts. A. Physical interdiction, seize tankers, disrupt dark routes. B. Market gating, route legal sales through US-approved channels. C. Financial capture, place proceeds in supervised accounts, releasing money conditionally. That combination forces re-dollarization in practice, not because everyone suddenly loves the dollar, but because the corridor is being rebuilt, so the default clearing route touches US-supervised institutions again. And here's the strategic punchline. When you can't win at layer 2, you dominate layer 3. If stablecoins let money move, you don't only regulate the wallet, you seize the ship. The legal machine, how OFAC turns oil into blocked property. A lot of people hear sanctions and imagine a press conference. In reality, sanctions are a targeting system. Look at how Treasury describes it. Vessels and firms that transport Venezuelan oil can be designated, their property interests can be blocked, and even specific tankers can be treated as blocked property. Treasury also emphasizes that anyone involved in Venezuelan oil trade faces significant sanctions risk. That is how you weaponize the hallway, not by arguing about currency, by making every intermediary afraid to touch the deal. Treasury's own language is blunt. The shadow fleet generates revenue and fuels the regime, so the US targets the fleet and the operators. And here's why this matters for the petrodollar debate. The petrodollar is enforced partly by law. If the legal environment makes dollar-cleared routes the only safe routes, then even countries that hate the US can be pushed back toward dollar clearing, simply because everyone else refuses the risk. You don't need a global vote. You only need a global fear of being the next sanctioned middleman. Treasury also spells out a practical trap called the 50% rule logics. Once entities are blocked, their property and interests in property are blocked, and entities owned 50% or more by blocked persons are also blocked. That's how the net widens. One designation can contaminate a whole corporate tree. And suddenly, creative routing isn't creative, it's radioactive. So when you hear US pressure campaign, translate it into operational terms. Identify the ship, identify the operator, designate the entity, block the property, scare the insurer, scare the port, and the corridor collapses. Why diluent plus equipment is not a detail. It's the throttle. Now, let's connect one technical detail to strategy. Argus reported that the US was talking about supplying diluents and equipment to enable a boost in Venezuelan output. AP also described plans to authorize imports of oilfield equipment, parts and services to increase production. That matters because production is not just oil in the ground, it's a chain. Maintenance, dilution, blending, storage, pipelines, export terminals, and steady spare parts. So if a foreign power can both 1. Gate the marketing of the oil, and 2. Gate the inputs that keep production stable, then it effectively controls the throttle. That is another form of custody. Not custody of a single barrel, custody of the flow. And once you control the flow, you can design the incentives, cooperate, and the throttle opens, resist, and the throttle tightens. That is why the word indefinitely is so loaded. It implies a standing control structure, not a temporary emergency patch. The message to other nations: payment rails are not enough. Venezuela's case demonstrates something people hate admitting. The end of the petrodollar is not a smooth, linear transition. It's contested. And when it's contested, it can turn physical. The message is this: you can price oil in yuan. You can settle in stablecoins. But if you don't control custody, if you can't protect the corridor, your currency preference can be overridden by someone who can. And that should change how we talk about alternatives, because there are 3 different ends people confuse. End 1, multipolar pricing, more invoices in non-USD units. End 2, multipolar clearing, less reliance on US-exposed banks. End 3, multipolar custody, protected corridors and enforceable delivery, independent of US interdiction. We are seeing End 1 in parts of the world. Venezuela tried to push into End 2 with USDT. January 2026 shows how hard End 3 is. China and the shadow markets. When discounted barrels get harder, Obiki Nizash. Now zoom out to China. Wall Street Journal described how China has benefited from black market oil from sanctioned producers, including Venezuela, and how tightening enforcement is making that trade harder. It framed this as part of a broader crackdown on the shadow oil market. This matters because China didn't just buy barrels. China bought an advantage, discounted energy, in exchange for taking compliance risk. But when enforcement intensifies, the math changes. Discounts shrink because risk rises. Shipping costs rise because routing and insurance get more complicated. Volumes break because the shadow fleet gets hunted. And the buyer's negotiating position weakens because delivery becomes uncertain. When the corridor is contested, the barrel is no longer cheap oil. It's oil that might not arrive, and that forces stockpiles, alternative suppliers, and political bargaining, none of which are free. So Venezuela's removal as a cheap non-dollar node weakens the broader dream of a Petro-Yuan ecosystem, at least near term, because it shows that nodes can be physically removed from the network. Cuba, why downstream pressure is part of the strategy. Now, Cuba. On January 11th, Reuters reported, Trump said no more Venezuelan oil or money would go to Cuba. Reuters also cited shipping data showing no cargoes departed for Cuba since Maduro's capture amid the blockade, and it reported Venezuela had been Cuba's largest supplier with around 26,500 barrels per day of crude and fuel last year, covering roughly half of Cuba's oil deficit. This is not a side story, it's the downstream pressure test. Fuel flows keep governments alive. So if you can disrupt the fuel artery, you can reshape negotiations across an entire region. Venezuela isn't a single node. It's a node feeding other nodes. And when a system wants to reassert control, it squeezes the network, not just the source. Strategically, that's how you turn oil into leverage without firing a shot at the buyer. FEDO, re-dollarization. Explained, it's not love, it's plumbing. Let's define the phrase we're using. Re-dollarization doesn't mean Venezuela suddenly becomes pro-US. It means the oil trade is forced back into dollar-cleared channels by external gatekeeping. AP described a model where proceeds settle into US-controlled accounts at major banks, and then money is dispersed at US discretion. AP also described a framework for enabling sale of Venezuelan oil while controlling proceeds. That's not just a currency choice, that's a governance choice. Because whoever controls disbursement controls priorities: debts, repairs, imports, humanitarian spending, and who gets paid first. Escrow is power. If you've ever watched a business acquisition escrow, you understand this. The person who controls the account controls the tempo. They can slow it down, speed it up, freeze it, or condition it. Now apply that to a country with oil. That's why I keep saying this isn't a story about pricing, it's a story about permission. The stablecoin. Twist. Why USDT becomes a national security issue. Now crypto, because this is where a lot of people get it wrong. Venezuela's USDT strategy wasn't anti-dollar. USDT is a dollar proxy. It's dollar value without dollar banks. That creates an enforcement leak, and enforcement leaks trigger clampdowns. Reuters 2024 reporting framed USDT usage as a way to reduce bank freeze risk under sanctions. Policy analysis has been explicit that crypto-based settlement changes sanctions dynamics because it shifts choke points from banks to wallets and intermediaries. And US Treasury messaging emphasized significant sanctions risk for those involved in Venezuelan oil trade and described the role of shadow fleet networks. So here's the strategic forecast. Expect tighter controls around stablecoin interfaces, exchanges, OTC desks, and identifiable wallet clusters, linked to commodity settlements. Not because stablecoins are doomed, but because stablecoins, used at scale for sanctioned oil, compete with the choke points sanctions rely on. The goal won't be ban the technology. The goal will be restore the choke points. What this does to the end of the petrodollar narrative. So, is this the end of the petrodollar? If you mean, will countries try to diversify away from US exposure? Yes, that trend exists. If you mean, can the dollar be replaced smoothly in energy trade just through new invoices and new slogans? Venezuela just delivered a very expensive no, because the petrodollar isn't only a currency habit, it's a stack. Legal reach, sanctions plus secondary sanctions, clearing norms, banks, trade finance, compliance, insurance conventions, who will cover what under what legal exposure, and the ability to physically enforce corridors. In January 2026, the reported strategy wasn't convince the world. It was capture the corridor and the escrow. That doesn't mean the petrodollar is immortal. It means the fight is not purely financial, it's logistical. And when fights become logistical, the winners are the ones who can enforce custody. Pre-fekond. Investor translation. Your 10-point reality check. Now, what do you do with this as a viewer and market participant? Here's a checklist you can reuse anywhere. Invoice versus reality. A headline about pricing is Layer 1. Ask what Layer 2 and Layer 3 look like. Watch shipping first. When shadow corridors are disrupted, discounts and supply flows change early. FX narratives often lag. Watch escrow structures. If proceeds are supervised and dispersed conditionally, the seller is not fully the seller. Watch insurance and port access. You can have a buyer and a barrel. If you can't insure the route or dock the ship, it's a paper deal. Watch sanctions language. Treasury actions that name vessels and operators are not news. They're warnings to every intermediary. Step away or be next. Watch who gets equipment. AP described plans to authorize oil field equipment imports to increase production and referenced Venezuela's output around roughly 1 million barrels per day. Watch the downstream. When a supplier is cut off, downstream regimes feel it. That's where energy finance becomes political stability. Watch for selective sanctions relief. AP's outline of selectively removing sanctions to enable sales is a clue. The goal can be control, not isolation. Watch the language. Indefinitely. Indefinitely means template, not temporary. Watch second-order reactions. If Venezuela's corridor gets gated, other sanctioned exporters adapt. New routes, new intermediaries, new blends. Markets then reprice risk in slow motion. If you can track these 10, you're tracking the real petrodollar fight, not the meme version. Venezuela's outlook. Volatility. First, conditional rebuild later. Let's finish with Venezuela's practical outlook. Short-term volatility and disruption. When shadow channels are interrupted, exports don't instantly reroute into clean, compliant flow. Documentation, counterparties, insurance, and logistics have to reset. Revenue can freeze, not because oil disappears, but because the corridor is being rebuilt with new gatekeepers. Medium-term, conditional rebuild. AP described proceeds settling into US-controlled accounts and being dispersed at US discretion, and it reported PDVSA negotiating with the US under a commercial scheme. Reuters described Treasury-supervised accounts tied to an oil supply deal as a test of the emerging relationship with an interim Venezuelan government. That implies a model where Venezuela's oil sector might be stabilized and even expanded. But fiscal autonomy is constrained. If the gatekeeper holds the escrow, the state loses the steering wheel. You might get higher production and more predictable exports, But the sovereignty trade-off is massive, and that trade-off is the hidden price behind re-dollarization. The next 30-90 days. 3 scenarios to watch. To keep this practical, here are 3 forward paths. Each one changes the petrodollar story in a different way. Scenario A. Hard gatekeeping, tight corridor, tight escrow. The blockade and seizures continue, shadow routes stay risky, and official sales expand only through US-approved structures. In this scenario, Venezuela's oil becomes a controlled asset, marketed outward, proceeds held inward. Scenario B. Selective normalization, more barrels, still supervised. Sanctions relief expands selectively, equipment flows in, output rises. But the escrow model remains, money released conditionally. This scenario boosts global supply without restoring full sovereignty. Scenario C. Contested escalation. Corridor becomes a flashpoint. If seizures draw stronger pushback, legal, diplomatic or operational, the corridor itself becomes the story. And when corridors become contested, energy markets price not just supply, but enforcement risk. What should you watch in real time? New OFAC designations tied to shipping managers and front companies. Any updates to the indefinitely sales framework and where proceeds are held. Whether China's discounted barrel channel tightens further. Downstream pressure points like Cuba's fuel situation. Because those are the dials: law, escrow, corridor, and downstream. One last tip. Don't wait for a headline to confirm a regime shift. Watch the boring signals, insurance refusals, port denials, sudden ship-to-ship transfers moving farther offshore, and payment terms that quietly switch from net 30 to pay first or no cargo. Those micro signals usually move before the big narrative does, because traders adapt first and politicians explain later. In a corridor war, the first thing that breaks isn't the price, it's certainty, and uncertainty is where leverage is made. That's the real battlefield. Okay. The 3 questions that cut through the noise. 3 questions that... So the next time someone tells you the petrodollar is dead, ask 3 questions. Who controls the corridor? Who controls the escrow? Who controls the switchboard? Because in January 2026, Venezuela didn't show us a world beyond the dollar. It showed us how the dollar system reasserts itself when it decides a node matters.